Well, good morning, Anton, and thanks for joining us. The stock market's had an impressive run over the last 6 months. Do you see this as something that can continue into 2014?
Look, again, a lot of the run in the market, I guess, the improvement has been due to two reasons. Number one, I think confidence in the economy is a bit better. You know, the US appears to have stabilised. Europe, the crisis is not we're not reading about any new crisis every month as we were for a while. China appears to be doing a bit better as well. So there is a bit more confidence in the sustainability of those economies, I think. But I think the other big factor that's really led to this jump in the market has also been the continued low interest rates, not just overseas, but in Australia we've seen the short-term rate drop to record lows. So we've got low interest rates, zero in the US, zero in Japan, close to zero in Europe. In Australia, 2.5%, which is a multi-year low. Plus we've got central banks, the Fed Reserve still buying 85 billion worth of bonds, the Japanese just starting, the Europeans doing whatever they can as well to stabilise some of the weaker economies. So all that liquidity is leading to this rush of blood a little bit in the market. So how sustainable it is, look, it's difficult to see it reverse in the short term. However, I think you'd have to say there's few bargains around, and maybe stocks are getting a little bit ahead of where the earnings are. So you've either got to see, the earnings have really got to start picking up now to start justifying some of the valuations that we're seeing, particularly on the cyclical stocks. A lot of cyclical stocks now are factoring in a very robust recovery in 2014, and that is not us, and we don't believe that's correct. At this stage, whatever recovery we'll have next year looks like it'll be fairly, quite a weak recovery.
And what impact do you see the ongoing US debt situation having on the Australian market?
Look, the US debt situation is just part of a bit of the global mess that we're in. The Europeans have got huge budget deficit problems. The Americans have got huge deficit problems. Australia, we've got a deficit issue we have to address at some stage. So, look, it's in reality it's not new news. It's just a sorting out, I guess, of the lavish spending that we've seen governments. They've had revenues decline because of higher unemployment. So obviously when unemployment goes up, taxes go down and your unemployment benefits go up, which is very bad for your deficit. So you've had a number of events affecting budget deficits, and governments have got to sort that out. And the US, this whole debate in the US is part about addressing how to get their budget back into some sort of order. So it's not a total surprise.
And what areas of growth, if any, do you see for the Australian economy over the next 12 months?
Oh, so it's tough, I think most people agree that Australia will have a fairly patchy recovery. Clearly, the mining capex is coming to an end. All the big new mines. There's probably another year, 18 months, but beyond that starts to slow. Having said that, things are not that bad because the iron ore industry is still doing very well, and iron ore prices are high, etc. So and the LNG production in Queensland starts in 2015. So there are still some areas doing well, but in terms of the general economy, we think it's going to be very patchy. And we're still focusing on areas we think can continue to grow, such as healthcare, gaming, those sort of areas. We're not expecting a huge recovery in some of these more difficult areas like retail or building construction in the next 12 months.
So what is your message to investors with Investors Mutual and in the Australian stock market?
In our fund at the moment, I would say, hang in there. We're doing the best we can. We're trying to pick what we think are the best stocks in what looks like a very strong market. We're lagging the market at the moment as it runs. We're not sort of designed as a racing car. We like to think of ourselves more as a kind of steady ship than a racing car. And we're doing the best we can to make sure that the portfolio, while it participates in the rise in the market, should there be a change of direction, a sudden change of sentiment, that we can hopefully hold on to most of the value there. Because I think one thing I've learned over 15 years or 25 years that I've been managing money, and certainly a lot of people have learned, is that markets can change direction very, very quickly. And while everyone can be very bullish this week, next week something out of left field can happen, and suddenly everyone's kind of the world's still the same, but everyone's bearish. So I think what's important to us is to look at our portfolio every day and say, can we justify holding the stocks we have today, you know, based on the scenario we think of a continued choppy economy, you know, can we justify holding what we have today? So we're pretty comfortable with what we own in the portfolio. The market's running very strongly, so, you know, we're participating in some of that upside. But to us, the importance is to make sure that if there is a change of sentiment, that the portfolio will hold up very well. That's the key to us now.
Excellent, Anton. Thank you very much.